Now we're live. All right, we are live. Hello and welcome to all of our listeners. We are delighted today to be discussing the intrinsic value of crypto with Richard Galvin, who leads the DACM, a fundamentally driven crypto hedge fund in Australia, though with an investor base from all over the world. He's got a long experience in the world of crypto and in TradFi, and has been pioneering the Australian crypto space. We're very happy to have you here with us today, Richard Galvin, and also Katalin Tischhauser, who is the head of research here at Sygnum Bank. She's also the author of most of our investment research that we put out, and also leads the investment research for the products that we have here at Sygnum. Thank you both so much for joining us today on this webinar. And we'll be looking into this new report, Valuing Crypto Assets, and really diving into the valuation fundamentals that help with growth forecasting. And I don't want to spend too much time, with the introductions and so on, so I want to dive right into it. So maybe first a question to you, Richard.
Sure.
Do crypto assets have intrinsic value?
Some of them do, yes. I think it's a small but growing sort of subsector of the whole asset class that does have intrinsic value. And by intrinsic value, I think the easiest way to qualify or quantify that is really on cash flow yields. And there are a number of crypto assets that deliver cash flow yields to their holders today. So I think that's the easiest, most quantifiable way to sort of put your finger on intrinsic value. And I'm sure we'll talk about sort of other approaches and other methodologies used to find that as well. But there are absolutely crypto assets that deliver cash flow type yields. Now, outside of that, there's all sorts of other experimentation, things like Dogecoin and those, and other sorts of assets that don't have underlying intrinsic value in our view. But look, it's a new asset class, and we're very comfortable with people trying new things, new business models, new ways to build networks. It's just that, we would say they don't have intrinsic value. It doesn't mean they've got no value, and clearly they don't because they trade at some sort of value. But for where we specialize, it's more around those cash flow type fee-driven assets in the crypto space.
Sure, Katalin.
Yeah. So what I would add is that when crypto can be many things, and it can be compared to other assets that are somewhat like it. So, for example, decentralized projects that generate revenue and that hopefully trickles down to the token, or it doesn't, in which case it's a problem. That's quite similar to traditional assets that give exposure to some kind of economic activity, like stocks or bonds, where there's, like you said, there's some kind of a cash flow. And that is the case for quite a lot of crypto assets. I would even say that is the case for protocol tokens like Ethereum or anything proof of stake, where the transaction fees basically are a cash flow that actually creates value for the token. But we can also compare crypto to currencies, for example, or store of value assets like gold. And to the extent anybody can say that currencies have intrinsic value because there is reliable demand for it, right? And that demand could evaporate for the dollar, for the Argentine peso, for any of these currencies. Crypto is at least in the same league in terms of there being a degree of demand, both in terms of kind of store of value and medium of exchange. And in terms of them, what I find very curious is that people, even very big names like Nassim Taleb, when they say, well, crypto has no fundamental value, it's fundamentally worthless, there is almost never a justification provided. There is almost never an analysis that says the reason why it doesn't. It's just sort of a statement that hangs in the air, or the most that I have ever heard, I don't know if you have heard anything deeper than that, Richard, but the most I have heard is that it's not backed by anything. But that's a very frivolous argument, because neither is the US dollar. And in terms of projects that are backed by cash flows, it's the same as stocks or bonds. Would you agree with that?
Yeah, I think it's true. I think often there seems to be some criticism of the fact that tokens are generated and created and then grow over time. and you're creating a token that follows on from your point, it's not backed by anything. But I mean, when you create a company and you issue equity, it's not backed by anything initially either.
It's analogous to.
Yeah, it's like any growth asset that,
yeah,
the value of the economic unit and whatever it may be always generally should look forward, particularly for a growth asset. And so over time it will grow into that. But at the point of issuance, then clearly the value from an intrinsic perspective is very low. At the same point as when, if we incorporated a business tomorrow that hadn't, had 1 day of operations, clearly the intrinsic value is low, but you don't criticize it 2 years down the track and say it was created out of thin air. It was created with the prospects of future cash flow and future economic activity and growth.
Yeah, indeed. And I completely agree with you that certainly some crypto assets have no intrinsic value. and it's very unfortunate, I think. And this is why I think it's important to have these conversations, because the better the market understands and can distinguish between assets with value and assets without, the better it is for the market. So to my mind, the kind of meme coins or, tokens, even tokens of very useful projects that generate an income for the project, but it has the income doesn't trickle down to the token in any way. There is no mechanism. These kinds of tokens have no value actually, and the sooner the market understands how to identify the projects that do or don't have value, the better it is for the market.
Sure. I mean, you guys have talked a little bit about different types of coins or different types of assets, and some of them may be cash flow backed or store of value backed, or maybe just meme coins. For the ones that we say do have intrinsic value, why is it so hard to in fact value them? Maybe Katalin.
No, Richard, please have a go.
Well, I think crypto assets, particularly with the network overlay, are super high growth assets. Basically across the sector. I mean, it's a new sector, and I think the reality is anyone that's worked through traditional valuation methodologies understands that valuing high growth, future orientated assets is always more difficult than steady state, cash flow driven assets, or even fixed income assets, even easier than that. So you straight away put in crypto, given its high growth nature, into the the hardest basket, even in a traditional finance sense, to value, because the high growth future cash flows, you need to make a lot of assumptions based on multi-year projections to come up with value. And when you make assumptions like that and value is in the future, anyone that's worked out MPVs or DCFs or similar type methodologies before knows that small changes can make small absolute changes on that path or that trajectory can make big present day changes in your valuation. In addition to that, so they're already in that category of high growth assets, which are the hardest assets to value in my view, and I think would be consensus about almost anyone who's looked at financial analysis. In addition to that, you have new business models, and you have completely new business models, and you have a completely new asset class. So you're basically adding, degrees of difficulty on top of just the high growth nature of the assets. In that you've got, business models that are changing that haven't been determined yet, or economic models that are changing or yet to be fully sort of determined. They're not fixed. Ethereum's economic model is very different to MakerDAO's economic model in terms of what it's got on its token. Whereas, when you're looking at high growth equities, they all come back to the same effective legal structure and generally have the same way of returning that value. Whereas in crypto, there's a lot of experimentation going around how to return that value. So you're adding those multiple layers of, I guess, uncertainty on top of what's already a hard sort of asset to value, even if it was in the normal construct of an equity, which, we've got a couple of 100 years of experience valuing.
Yeah, I have very little to add to that, really. I completely agree with everything you said, Richard. And I think just maybe to highlight how diverse the token supply models, the incentive models. So even if the market capitalization is estimated, which already is difficult for all the reasons you mentioned, then to translate it into a per token price with token burns and issuance models that depend on a lot of things are maybe algorithmic or they're certainly very diverse across tokens. And maybe one more thing to add is the data challenges. And actually, it's maybe an odd point, because one of the advantages of blockchain is that it's transparent and all the data is right there on the blockchain. Anybody can freely access it anytime. But actually, it takes quite a bit to access that data. It's not. It requires interfaces and so on, and it has to be differently constructed for the data extraction for every blockchain. So actually, to have kind of the quantity and quality of data at a cost and time that the investor can afford is not trivial.
Sure. I mean, also, when looking at this asset class, right, like we're not talking about different ways in which we can value crypto, but there has been, and Katalin, you touched on this before, that a lot of people outside just saying, oh, there is no intrinsic value at all. Why do you think people say this? I mean, even just last week, we had Ben McKinsey's new book coming out where he's again saying that crypto has no intrinsic value. How do people maybe justify this, and why do you think maybe that they're not right?
I think the flag bearer asset, by far the dominant asset, is Bitcoin, that really has only that sort of currency type value we spoke briefly about earlier, right? So I guess it's probably a little unfortunate. Well, probably not unfortunate, but it's a little noisy in the space that the key asset, the biggest asset, probably is the hardest one to sort of put intrinsic values on. And I guess most of the sort of what I'd say is assets that look more traditional, like in terms of cash flows and fees, albeit Ethereum's probably changing that a lot over the last 10 months or so. But a lot of the other assets that have those, what I'd say is more traditional cash flow type attributes to them, are much smaller, much less known, and there's not a lot of people making this commentary that have spent months and years researching the space to find these sort of assets or understand them. So I think that there's that native knowledge that you need to have. I mean, people aren't showing these assets at university. They're not covered by brokers really to any extent, although there's obviously emerging research being done by parties out there. They're not researched well and not delivered in anywhere near the level that you see for other asset class to investors. So unless you kind of roll up your sleeves and go down the rabbit hole, you're going to struggle to find these sorts of assets, which is negative, I guess, for the perception of the whole space. Great for investors like us, where you can find those sorts of opportunities that are poorly understood and look for that value to be realized over time.
Yeah, and maybe one more thing I would add to that is the proof of work, proof of stake distinction, because basically all blockchain generates transactions and charges transaction fees. So that is a fundamental economic activity that is taking place. But with proof of work, it leaks it to external parties, the miners, right? And proof of stake keeps it inside the ecosystem of the token itself. So they're actually economically very different propositions in terms of intrinsic value from the transaction fee economy, with proof of stake being far, far more valuable per dollar of transaction taking place on the network.
Sure. And I mean, like you said, like maybe people who've been in this space for a little while have a bit of an advantage because they understand how to read what is happening in the space. But there are some fundamental differences. So like you said, that there isn't, historically this being taught in universities or some sort of kind of inherent knowledge with all the brokers and so on. But there are some advantages that investors in this space do have. Would you agree with that, Richard?
Yeah, I think absolutely. I think we need to be cognizant as well that whilst equities have been, companies have been around for hundreds of years, and people have been doing certain forms of research for them over that period to try and assess value and what they're worth. Even the valuation methodologies of equities has changed materially, even over my time in financial markets. So just to give you a sense, valuing assets is a relatively changing sort of landscape, even in something as old and established as equities. I mean, prior to the .com kind of boom in the mid to late 90s, the concept of a revenue multiple was extremely scarce in terms of its use, and was, I'd never seen it really quoted in a research report used as any sort of valuation methodology before. And then along comes, these new businesses focused around the internet within a normal construct of a company, and accounted for like a company, but with business models where they were looking to move to profitability on much longer timescales than any sort of businesses before them, right? With much higher growth and much more leniency from the market to have to generate short-term profits or any type of kind of return cash flow, unlike anything we'd seen before in terms of the leniency of time they had to do that. And so out of that came new ways to look at valuing that sort of new or subsector of equities. And so people start to look at revenue multiples, which are well and truly prevalent today. But even back when I started in my career, I guess I'm pretty old for a crypto guy, but back in sort of the mid 90s, no one was talking about revenue multiples, and you would have kind of got laughed at if you were valuing businesses back then. But even in that sort of 25-year span, we've seen a new way of looking at growth equity. So this is an evolving space. It's not as if this is the first time crypto's thrown challenges to the way to value assets, and those investors that can value them right or can get it more right than wrong are the ones that can deliver pretty significant outperformance if they can sort of be ahead of the market in the way they look at value.
Sure. Katalin?
Yeah, indeed. Nothing to add to that. I really agree with those points, and I think it's clearly the case that there is still an advantage to people who have long-standing experience in the market and a deep understanding of the assets. So firms like DACM and a few other hedge funds still have this sort of asymmetric advantage in identifying value and benefiting over the medium term. This is obviously value investing rather than short-term trading, so there can be sort of short-term volatility. But I think the better value is understood across the market, the better it is for the market, because frankly, these kind of tulip manias like the ICO boom, 5-6 years back, or the meme coin manias, and these kinds of situations give crypto a bad name, that afterwards the market has to kind of work hard to recover from the negative image that these these periods then attach to crypto.
Sure. Obviously we're all in this space and we all care a lot about the space, but what do you think have been or can be the negative consequences of not really kind of opening your mind and understanding the value that crypto does have to offer?
Well, it's, you can ask the question from people who choose not to invest in crypto because they don't see the value. I think it's kind of missing out on something transformational and potentially extremely lucrative as far as investments are concerned over the medium to long term. People who are in the market and choose not to understand what they invest in, that's more immediately obvious. That's a sure way to lose money.
I think the reality is it still remains, even over the last few months where volatility has obviously become substantially lower, it still remains an asset class that's kind of off the scale in terms of volatility versus almost every other market in the world. So, one of the things that we look for around understanding value and bringing sort of fundamental analysis to the assets we buy is, they need to make it through an extremely volatile market and cycle. And, so you need to have something to, I guess, and that volatility is not just in price as well, it's also in user levels and fee levels, which are, highly volatile and cyclical as well. So you need to have sort of a fundamental assets that you own that can actually see it through the cycle in crypto. And, the worst thing, one of the worst things you can do as an investor is pick the right sort of asset class or the right sort of area to invest, but pick the wrong assets or the assets within that sector. And, to look back 10 years in the future and say, I got it right. I knew crypto's growing. It's become this huge disruptive technology like we all have conviction it's going to be. But you look back in 10 years and go, I got that call exactly right. But the 5 or 10 assets that I bought didn't make it through a cycle and therefore didn't sort of have a shot at the title, so to speak, as activity picked up. And they sort of, I was in the right sector but in the wrong assets. So from our perspective, fundamental research and fundamental assets that we buy is absolutely fundamental. Make sure that the things and the projects we're investing in can see through that volatility. and make sure they continue to grow as we start to sort of see those upswings in the cycle.
Yeah, absolutely. And I think, professional investment firms like the ACM, you obviously understand very well what you're investing in. That's what you do. But I think it's also for, let's say, private investors or anybody who chooses to engage with crypto. I think it's important and very good to understand your own investment thesis, to kind of appreciate why you invested in that token, that you had maybe certain expectations for growth or delivery, or the project capturing market share, or being able to deliver certain functionalities and so on, so you can track it against the news flow, right? So that's even obviously not just for professional investors, but for anyone. The better you understand why you invested in something, the better the chance that it's going to be profitable for you.
Yeah. And speaking of, investment theses in this space, maybe Richard, in like a step-by-step way, maybe can you walk us through the sort of methodology you use as when investing in crypto?
Yeah, I think you've got to, because business models are immature and developing, and the categorization of different assets within crypto are very different, right? So, Bitcoin is very different to a derivatives trading app, right? They're extremely different assets. So, the first thing you need to work through is, what category does it sit, and which sort of tools or approaches to analysis will I implement to form a view on value, right? So the categorization is kind of that first sort of step that we look through. And then, a bunch of the approaches we use then would be very familiar to anyone that's looked at company valuations and equities valuations, and then a bunch of them are very nuanced and very focused on specific crypto type analysis. So I guess the top of our list is looking at that sort of user growth, utility, derivation, followed by cash flow or fee stream. So like any technology, from our perspective, the way we invest is, will people use this protocol or this application? Because ultimately, if you can attract a lot of users, that's kind of the first hurdle. Then if you can deliver a lot of utility, that's kind of the second hurdle, which then generates the economic value, which usually is shown in a fee or some sort of similar type attribute that a token has. And once you go down that path and you start to estimate those attributes, then you can start to put typical cash flow type analysis, DCFs and other sorts of methodologies, relative value multiples around an asset to try and form a view on, its overvaluation or undervaluation. So it's firstly sort of cutting the asset into its right sort of category, and then using or applying those cash flow type methodologies around that. Then in addition to that, you start to get down to what I'd say is more specific crypto type valuation techniques. The first of which outside of that would be a security value type analysis, right? Which is a very specific thing for crypto, but ultimately a lot of crypto blockchains have a lot of value that's stored on top of them or secured by them. And clearly, as the value that's secured on a blockchain goes up, the value of a blockchain, given that, and I don't want to get too caught down in details, but blockchains can be attacked effectively. The incentive to attack the blockchain and try and steal that value, for want of a better word, goes up as the value goes up. And there is a pretty strong relationship between that value that's stored on a blockchain going up and the value of that blockchain going up, because that's the security underlay of it. And so you look at that sort of growth in the value that's stored on a blockchain and project that forward, and that gives you some sort of security value that blockchain needs to keep up to make sure that those assets are secured. And the market's been pretty good at rewarding or valuing relatively loosely, but there is still correlation between the value of the underlying blockchain and the assets that are on top of that. In addition to that, you have, as we spoke briefly about earlier, there is monetary value to some things in crypto, and I would argue that Ethereum, which is the second biggest asset in the class, has the first two attributes, but also has the third. Ethereum can be collateralized across all sorts of different applications, can be used as collateral in all sorts of derivatives exchanges and all sorts of things. And so, all else being equal, an asset with the same user base and the same revenue fee that doesn't have that sort of attribute that can be monetized quickly should trade at a discount to Ethereum. And so you have that sort of monetary overlay as well, where these assets can not only be used to get cash flow, they can be used to be collateralized to do other sorts of like lending, trading, whatever it may be, which has some value. So you're starting to build sort of a sum of the parts type approach to valuing these assets. And then in addition to that, you have other attributes that may be relevant for that specific application or that specific blockchain. In particular, in our perspective, if you look at an asset class that moves as quickly as crypto, that has network effects, understanding how those network effects work and understanding the catalysts that can kind of keep that network growth growing is critically important, and trying to estimate how those catalysts will roll out and how that network effects will take hold is kind of one of the key things that we try to bring to the table when we're investing, because investing in crypto is a high risk thing. So when you're taking a high risk investment, you want the true upside, that sort of asymmetric upside that only crypto can offer. So getting those parts right is pretty important to make sure you're in the right sort of assets that can offer that sort of asymmetric upside.
Amazing. And Katalin, what way would you say our approach may be similar or a little bit different than the points that Richard covered?
Yeah, so the approach we offer is, so we publish research and kind of offer it as our thoughts. We don't have a fund that would be similar to Richard's fund or do the same kind of investing at this point. Our investment products are either passive or multi-manager currently, but we do think about it, and it is the modular approach that is very similar to what Richard described, to look at the various sources of value for a token, which is one part of how we look at valuation. The other part of it is, again, repeating what Richard said, but recognizing that we're valuing high growth here. So taking into account anything that can help you with valuing growth, but also recognizing the challenges of it and discounting it appropriately, and kind of taking into account the various risk factors and uncertainties that increase when you value something where the growth is somewhat further out in the future. And then obviously just to really understand the mechanics and the complexities of the supply models, the tokenomics, the incentive structures, because like I mentioned before, it's one thing to arrive at a value for the project, and then to translate that into the token is far more complicated in crypto than in shares. Once you value the company, you know how many shares are outstanding, and sort of that's a fairly trivial conversion. And in crypto, that is not the case with large holders, vesting tokens. Can the supply model be changed? Governance rights, are they valuable or not? It depends on what you're allowed to vote on, right? If you're allowed to vote on the logo for the company, or if you're allowed to vote on economics that you can then channel to the token, then those have value. So then kind of just considering a long list of complexities.
Sure. I mean, this is also something that Richard touched on, right? Like there's different ways of valuing it, like monetary value or security value and the size of the network. But fundamentally also investing in this asset class is making the bet to do it. And then the second would be to make the right bets, to pick the winners off everybody that's in the growth journey right now.
Yeah, absolutely. And one more point I would make is that yes, it's very important to get the right projects in every sector or subsector, but it's also extremely important to invest in the right sector. So that's also maybe one layer between, do I want to invest in crypto at all? Then the next point is just to think about what use cases, what themes, what activities are actually reasonable, valuable, appear to be taking off, that it's maybe early enough that it's profitable, but sort of it's already showing enough proof points that it's a worthwhile investment.
Yeah, I think that's an important point. I'd say over the 7 or so years that we've been doing this, that picking the right sectors has probably been the critical differentiator in terms of market outperformance. Correlations within sectors of crypto can be relatively high, particularly as those sectors start to grow and the market starts to sort of grapple with that extra growth. So you kind of get a second chance to then pick the right token if you're in the right sector. And so we've found, absolutely, that picking the right subsectors has kind of been the key alpha generation for us. And then, the sort of the cream on the top is getting the right assets within the right sort of subsector, but it's in that order.
Interesting. And maybe, of course, you don't have a crystal ball or anything, but what are the sectors that you're most interested in right now?
I think from our perspective, we look for we think crypto's at a pretty important transition phase from being kind of what I'd say is somewhat of a sort of a crossover use case between sort of utility generation and sort of tech driven users as well. So we're sort of at that stage similar to where we'd say the internet was at when it was sort of transitioning from sort of dial-up internet to broadband, where most of the users in that dial-up phase got some utility from the product, but also got utility from using the new tech and experimenting with the new tech. And I think crypto's in a similar phase today that a lot of the use cases on crypto deliver utility, but the user bases are still relatively tech-focused users that are willing to spend the time, roll up their sleeves to understand how to use the technology and maybe watch a YouTube video or whatever is required. From our perspective, we're sort of coming out of that sort of sandbox stage into the sort of mass market stage. So where we get excited looking forward over the next sort of 3 to 4 years is, what are the use cases? What are the projects that are going to make the technology easier to use, going to make it more accessible so the utility increases, and the users aren't focused on the tech, they're focused on the utility that the tech's delivering. And it's not just, well, I'm using a blockchain to do this. It's, I'm using this app to do this because it's faster, cheaper, easier than the way I was doing it last year in some Web 2 application. So we've spent a lot of time focusing around what I'd say sort of infrastructure type layer projects that are starting to make the tech easier to use. And that's where we see a lot of growth as we look forward over the next sort of 4 to 5 years.
Amazing. Katalin, you?
Yeah, so we also see a lot of value, especially after the bear market, where the customer-facing excitement kind of evaporated a little bit, and the projects, the use cases such as gaming or let's build a metaverse, I think this excitement around that died down quite a bit over the past year, and these sectors and these use cases are still there. And there's quite a lot of investment going into them. There's quite a lot of innovation that's brewing behind the scenes. But I think the focus shifted to building what will actually make crypto and blockchain, what will allow it to actually deliver the utility that it conceptually can deliver. So a lot of the what we call the Web3 sector or Web3 infrastructure, or also the layer 2 projects working on scalability, the projects working on interoperability, but also a lot of other pieces of the jigsaw, the decentralized data storage, data retrieval, GPU, sort of basically creating the foundation on which the customer-facing decentralized applications can build. I think one more thing to mention, that a lot of this still really goes to Ethereum, and we see Ethereum as rather undervalued, considering how much is going on there in terms of value creation and also in terms of the tokenomics of the project having been changed very much for the better in terms of supply demand for the token. So I think that's quite interesting. And there's many other projects competing with Ethereum, but really Ethereum's overwhelming market share with the network effects, it continues to be the go-to value generator really in the crypto space. I would say that Bitcoin has its special drivers that have less to do, although the developer activity has now revived with ordinals and the BRC20 and so on and so forth on Bitcoin as well. But really, it's much more about the global macro landscape, and then people looking to Bitcoin as what it was, I suppose, created to be an alternative safe haven asset. We have really seen that, for example, in the wake of the US banking crisis, and every piece of news on the global macro instability or geopolitical instability is sort of positive for Bitcoin, not to speak of the current catalysts of the Bitcoin ETF. So if a spot ETF, so if anything happens there, that's a specific catalyst. I think that has less to do with valuation and more to do with fund flows that would be coming in the direction of Bitcoin for a while. And other than that, I think we're looking to see some of the customer-facing applications that compete with their traditional counterparts, kind of see if they can get any traction, because really the arguments for having a decentralized alternative to centralized alternatives are quite strong across so many industries. So just waiting to see whether user traction takes off on any of these customer-facing applications. And that applies quite strongly to the whole decentralized finance sector as well. I would say basically DeFi came and grew into something that services the crypto market. So and for that, all the growth and all the price appreciation was appropriate, but it's circular. It's for now, it's lending to crypto traders, it's decentralized exchanges trading crypto, insuring crypto assets. And the next growth phase for decentralized finance is stepping outside that and basically really competing with the traditional financial institutions in terms of uncollateralized lending to real world entities, real world insurance, and so on and so forth. And there are projects working on all of these use cases, but it's still very early stage. I would say quite fast growing from a low base, but that's something also to keep an eye on.
Sure. Perfect. I mean, we've covered quite a lot of ground, and I think that's also as much time as we have for our listeners. If you want to learn more about how to consider valuation of crypto assets, there's a new report that we've just put out, and the link should be in the chat or also in the invitation to the webinar. And Katalin and Richard, thank you again so much for joining us today. It was really interesting to learn more about how you see the asset class. And until the next time, ciao.
Thanks for having me. Cheers.